Welcome to Adding Dollars. In this video, I'll be going over my weekly update on the highest volatility stocks. So stocks that are paying the highest premiums for covered calls and cash secured puts. Before jumping into this week's scan, if you are new to cash secured puts or covered calls, make sure to check out the videos in the description. Now let's go ahead and jump into this week's high volatility scan. As always, I'm in the Thinkorswim platform and I'm going to be on the scan tab and I'm going to be scanning the S&P 500. So let me go ahead and switch this to that and then click scan. And here we have a list of all of the stocks in the S&P 500 in descending order with the highest implied volatility at the top. And as always, this is after market data, so the numbers may change when the market opens. Based on this notification we have right here, it looks like a lot of stocks have earnings coming up soon, or they are having them right now. At the top of the list with the highest volatility, we have Enphase, currently trading at $105.44 with an implied volatility of 85%. And if we click here, we can see that they have earnings coming up on February 6th. So very soon, so it makes sense why the volatility looks very high as well. I'm going to jump over to the trade tab so we can see what kind of premium you could get if you did trade cash secured puts or covered calls on Enphase. And I'm going to be looking at the 7 days out options or options that expire in 7 days. As always, I have this custom column on my Thinkorswim platform that quickly calculates the percentage profit for cash secured puts and gives you an estimate for covered calls. It basically looks at how much premium you would get for selling a certain strike price and compares that against the risk in terms of if you did get assigned or if you got your stock taken away. Now let's go ahead and look at the option chain here. Because volatility is so high, you can currently make about 2% selling the $89 strike price put options and collect somewhere between $179 to maybe $185 in 7 days. And that would be about 2% profit in 7 days. The risk here is if you did end up getting assigned, you would need $8,900 in order to buy 100 shares. Additionally, earnings are coming up, so the stock could move really high or drop back down really low depending on how the market reacts to earnings. On the covered call side, you could currently buy 100 shares for $10,544, and then you could sell, let's say, the 107 call option and collect about $715 or 6.75% in just 7 days. These numbers are really high right now in terms of how much you could make because of the increased volatility, which does come with the risk of potentially the stock dropping lower or just skyrocketing much higher. Jumping back to the scan tab, we can look at a couple more stocks. Let's go ahead and look at Etsy. Looks like it has earnings coming up close to the end of February, but currently trading at $72 and has a volatility of 63%. Jumping to the trade tab, we can see the options chain here. It looks like you can make about 1% selling the $68 put options, collecting about $61 to $63, which would be about 1%. And your risk here would be if you did end up getting assigned, you would need $6,800 in order to purchase 100 shares. And on the covered call side, you could buy 100 shares for $7,262. And then you could go ahead and sell the, let's just say 75 call option for $140, which is about 1.9% profit in 7 days. Jumping back to the scan tab, we can take a look at a couple more. There are definitely a lot of stocks here with high implied volatility because of earnings most likely coming up very soon. Let's go ahead and take a look at Uber. We haven't looked at this one in a while, currently trading at $66.73. with an implied volatility of 48% and earnings coming up on February 7th. Jumping back to the trade tab, here we can see that you can trade the $61 put options and make about 1% in 7 days. This would be collecting about $58 in premium. The risk here, if you did get assigned, you would need 61, which is the strike price, times 100 because you're trading one contract. So you would need $6,100 if you did end up getting assigned in order to be able to purchase those 100 shares. On the covered call side, you could buy 100 shares for $6,673. And then you could sell the $67 strike price for about $250 or about 3.75% with a covered call. Jumping back to the scan tab, feel free to pause the video and take a look at the full list of S&P 500 stocks sorted by implied volatility. And if you enjoyed this video, don't forget to like and subscribe, and I'll see you all in the next one.